China's stock market is soaring to levels not seen in more than a decade. Investors have poured more than $1 trillion into the Chinese stock market, chasing returns in an uncertain economy. But with weak growth and ongoing trade tensions with the U.S., some fear the surge won't last. We spoke with China economic analyst Antonio Graceffo for his insight on Beijing's economic outlook.
Yeah, the thing is that when the Chinese economy slows down, Chinese people are basically conditioned that investing is safety. So, for Americans and Europeans, we tend to invest more when the economy is doing well and we have more disposable income. With Chinese people, when they feel threatened, they run out and invest, right? Because you want to lock your money up in something safe. And normally that has been, or historically that has been real estate, but the real estate sector is so bad right now that they're not investing in that. So then your other options are you could put the money in the bank or put the money in the stock market. The problem with the bank is that the bank interest rates are so preposterously low that there's no advantage to putting your money there, and this is driving money into the stock market. Basically, it's going into the stock market because there's no other investment alternatives open to them.
And as cash floods into the Chinese stock market, a large portion of it isn't coming from savings, it's borrowed money. Investors are taking on debt to chase returns on investments. But the move is raising fears that if stock prices fall, it could set off a chain reaction of selling.
Right now, the total margin in China exceeds 1 trillion yuan. It's something like, it's very close to 300 billion US dollars in margin right now. So these are people that are essentially buying stock on credit because the stock market is appreciating at a much faster value than the interest on the debt, the money that they're borrowing to buy the stocks. But obviously, if those stocks start to come down in value, there will be a massive sell-off. And as there's a sell-off, then it's a race to the bottom. The stock price keeps dropping, people keep selling, and next thing you know, your margin call comes, your margin is due, and you owe more than the value of the stock.
While domestic investors in China are pouring money in, foreign investors are taking a different approach. Many are pulling back as China's economy slows due to its ongoing trade tensions with the U.S.
So if you're an investor that invests according to fundamentals, you would be pulling your money out of China because fundamentals keep getting worse and worse and worse. The trade tension being a big part of it, but just generally the Chinese economy has been slowing because of the tariffs. Foreign direct investment in China is decreasing. Foreign companies in China are not expanding. There's any number of reasons not to invest in China anymore. And remember that a lot of the investment in China was because people wanted to manufacture in China and export to the United States. That's not really possible anymore.
China's stock market is seeing a surge driven by domestic investors at the moment, while foreign investors remain cautious. Analysts warn that the gains could be fragile. We'll keep a close eye on the upcoming trade negotiations between the U.S. and China and how it will impact Beijing's economy.